Welcome to a very special edition of NFM TV. I'm your host, Greg Sher, now joined by Jeff Reinhardt. He's a CPA and partner at powerhouse accounting firm KBST&M out of Baltimore. Jeff, thank you so much for rejoining us.
Glad to be back, Greg.
I say rejoining because Jeff was with us just a couple of weeks ago talking about the looming tax reform legislation. It is now a law. We have so much to go over. Let's start with the mortgage interest deduction. There was talk that that could possibly be eliminated. Was it?
Greg, no, that stayed in. We have a limit of $750,000 of debt that you can take that mortgage interest against, first or second homes.
And is that grandfathered in for those that are above the 750 threshold, or does everybody play by those new rules?
One of the nice provisions, Greg, is this grandfathering provision they did put in. So if you happen to have mortgages, first or second mortgages that total $1 million, you can deduct those going forward if you had them in place before December 15th.
And some bad news if you've been writing the interest off on lines of credit.
The line of credit, home equity lines of credit, the interest on that is no longer deductible.
Okay, here's a big one. Real estate tax deductions cannot exceed $10,000. To the average person out there, what does that mean?
Well, what we have now, Greg, is we have this combined deduction of property taxes, state and local income taxes, and all those together cannot exceed $10,000.
So is that a good thing? Is it a bad thing? You think that's going to hamper people?
Generally, it's going to be a cap. So generally, it's going to be a bad thing, especially for folks in high areas of high income tax. Now are going to be capped along with the property taxes. So that's a big negative.
And that could be why the NAR, after looking at this bill, they've lowered the impact in terms of how much it's going to hurt the housing market in terms of values of homes down to about 4%. They think that house values are going to go down 4% based on those big markets. Do you concur?
Well, I think, again, as we discussed last time, these are significant changes to tax law, especially how people deduct their interest and property taxes. And so from that standpoint, it would be easy to say that there's going to be some market shakeup.
Standard deductions from $12,000 to $24,000. This is a big helper. Tell us why.
Well, Greg, the tax system, we always have a called standard deduction. That's just a free deduction the government gives you, whether you itemize, own a home or not, and can take these other deductions. You mentioned $12,024. That's for married filing tax return. We're now going to have a $24,000 deduction, which is obviously a doubling and increasing amount. So that could be good for a lot of taxpayers.
Okay, let's go off the beaten path for a moment here and just hit on some nuggets. Child tax credit. Tell us about that.
Well, we've had a child tax credit for a long time now, Greg. It is $1,000 per child under 17, but it had some caps on, it was phased out at various income levels depending on your filing status. This bill doubles that, so now it's a $2,000 per child tax credit under the age of 17, and the expansion of the phase-out limits are much higher. It's roughly $400,000 for married filing joint. All
right, so that's big news, and so many people are trying to put money away for college education. Now I understand you can tap into that money sooner. How?
Well, Greg, 529 plans have been around for a while, and as most people know, are a tremendous savings vehicle. With this bill, you can now utilize your savings within those accounts for college as well as high school, elementary school, private tuitions, not just for college.
But let's move on now to meals and entertainment. This is a big one, a significant shift there in how that's viewed.
Greg, under previous law, a business could deduct the cost of entertaining clients for business purposes. The government allowed a 50% deduction on those costs. New law, those are completely non-deductible.
All right, we're going to focus now on some things that affect our important realtor partners. Realtors are the lifeblood of what we do at NFM. They're so important to us. So this falls under that category. First, we're going to talk about moving expenses. Oftentimes, realtors are representing people, buyers that want to move for a job from one community to another, one town to another. In the past, those expenses could be written off. How about now?
That's correct, Greg. Under prior law, if you had to move for a new job, you could deduct the cost of that move, moving your household items to the new place. Unfortunately, the new law, those are no longer deductible.
Oh, okay. So that's kind of a significant blow. What about the income of realtors? First of all, we know that they are, most of them, sole proprietors or S corps. There may be some nuggets in the law that helps them. Is that right?
There could be, Greg. There's a whole new provision in the law that allows for up to a 20% deduction of qualified small business income. This would apply to sole proprietorships, pass-through entities, S corps, LLCs. It's possible that real estate agents in some way could qualify for this deduction. However, it's very new and there's very complex provisions to this law.
Wow, we covered so much ground, Jeff, and I know people have a lot of questions, and so I want to pass along your contact information. Please let everyone know how they can reach you for some more clarification, and also tax planning for 2018, which is right around the corner.
Well, Greg, we're located in Baltimore, as you said. Our phone number is 410-308-0300. You can reach me there, or my email address is at the bottom of the screen.
What a pleasure having you. We thank you so much for the wealth of knowledge that you've shared with us today, and we look forward to talking to you again in the future.
I hope you have me back.
You've been watching a very special edition of NFM TV. We look forward to seeing you next time.